Hi, this is Todd Baker, your certified mortgage planner, and in this video I'm going to discuss how income is calculated for self-employed borrowers that are either 1099 or sole proprietor. And as a sole proprietor, that just means you're not an LLC or you don't have a corporation subchapter S or subchapter C. So if you're at a 1099 or sole proprietor, this is how your tax preparer is going to prepare your tax return. So I'm going to go over how it works and sort of a few tips on what to look for. And then what I encourage you to do is that many times when you're going to buy a home when you're self-employed, you just don't know, what you know is what you're typically, your mind's going to say, hey, I made 80,000 or 100 or 150, whatever it is, 50,000 a year. It's your gross income, but we're actually going to have to qualify for your net income. And the theory behind it is this. Almost always you have to go off of a 2-year average. If you ever see or hear anybody saying, no, you can do a 1-year return, there are very few loans that allow a 1-year return. There are some alternative mortgages, but I can tell you those are very difficult to close. They usually take 60 to 90 days, and it's a horror show trying to work with them, so I don't do them at all. The other way is with a Fannie Mae and Freddie Mac, a conventional loan, there are times when what you do is you run your loan through an automated underwriting engine, and it'll tell you how many tax returns they want. And if you've been self-employed for 5 years and you can prove that, depending on the loan profile and other variables, sometimes it only asks for 1-year return. But typically you need to plan on 2 years. That's number one. So figure 2-year history, and the idea behind that is that if we go back 2 years, that the income can be averaged, and that average is a good way of looking at a variable income, which self-employment is. It fluctuates monthly, right, and yearly. So 2 years is number one. Number two, it needs to be the same or going up. So let's say you make 50,000 one year and 20,000 the next. That's a red flag that maybe your business is going out of business, right? So number one, you have to address, is it still in business and what caused the loss? But number two, you can only use that single year average and not the 2-year average. So not only do we need 2 years, but we need 2 years with the same or upward trend, because that normally a business would tend to grow, right? That's healthy. So that's what we're going to look at. So what happens is this. This is the Schedule C that gets attached to your 1040. Normally you have your name of proprietor right there. So let me give you a quick tip. If you're 1099, the principal business or profession, let's say you're 1099 and you do truck driving, put truck driver in there. I mean, put in whatever it is, put the same thing each year if it's the same 1099 occupation. I see people that do one description 1 year and then they go to a different tax preparer and they put a different description the next year. Have whatever the description of what you do to earn that 1099, or if you're a sole proprietor, whatever your business name is, put it in there so it matches year after year and there's some consistency. The next thing that happens is 1099 income will be put right here. So another real quick tip. For some people, they get one 1099 from one company. Other people, they might get 1099 from multiple sources. They might have multiple vendors or multiple companies they do business with, and there's 2 different ways tax preparers will normally do those. Sometimes they'll do a Schedule C for each one. Sometimes they'll combine them all together. I think it's easier from my point of view as a loan officer to see them all in one form, because if you put them on separate forms, it's the same rule applies. It's a 2-year history. They need to be trending up as a net income average, and I'll show you how that works in a minute. But that's really something you ask your tax preparer about. If you're a sole proprietor, it's just your gross receipts. So if sole proprietor, right here, gross receipts of sale goes right here. So that's your gross income, right? And then you're able to come down here and you're able to deduct all these expenses. And there's even a spot, 27A, where they'll say see statement 1, and they'll itemize further expenses that don't go on here. So a couple things to note. If you use your car for business and you're eligible to write it off, it's really a great idea to have a separate checking account for your business, or even for expenses if you're on a 1099. So you can write all your expenses off there for accounting purposes, and for loan purposes, show that you make a car payment. Typically, if you have a car that's paid through the business and you can show in your tax return a corresponding amount that's deducted for that payment, you can omit that payment from your debt ratio. But the problem is that people don't do it right. In other words, there's a lot of people that use their car for business and maybe even write a check out of the business account, but they don't tell their CPA or hold their CPA or tax preparer accountable to say, hey, let's say, for example, your car payment's $500 a month. That's going to be, what's it's going to be $6,000 a year, right? Then that $6,000 along with the other expenses should be right here. This should be $6,000 plus any other business-related expenses if it's solely for business. So that's one thing to point out. The other thing is depreciation. Depreciation, and you can Google this and look it up, but depreciation is there's a formula for it, but what it is, it's for durable goods, equipment, assets. You buy a computer, if you have a car, you have a house, you have an office building, and really any kind of equipment. The idea is that when you buy equipment for business, it's going to lose value over time. You're allowed to deduct that depreciation. So you have to go over that with your tax preparer. But because it's a paper depreciation, depreciation is wonderful. I'll tell you why. Because it lowers your net income for tax purposes. But from a loan point of view, we get to add that back into income since it's not a hard expense. So what we do from a loan point of view, we're going to come down here and we're going to say, hey, what's your net profit? Okay, so the net profit, and then we have to deduct out whatever's in the meals and the deductible meals. Okay, so we have to deduct that out. So we take your net gain or loss, deduct out the meals, and then we add back depreciation. And then we do that, and we have a spreadsheet. And we do that for 2 years, and we average that out, and that's what gives you your qualifying income. So I have a lot of people that may have just started a business or may have also been really aggressive. Let me tell you what I see quite often. Someone goes to their CPA or they go to a tax preparer and they just dump every receipt they've ever had on them. And the tax preparer's job in their mind quite often is to take advantage of the tax code to limit your liability. The problem with that is if you're really super aggressive on your expense deduction, you're lowering that net income you can qualify for a home loan. That's always been a catch for self-employed borrowers. So you have to become aware. So the best way to become aware is a video like this, self-educate yourself. What I do a lot of time for clients is just when they send it in, I do the analysis, but in a coming tax year, we can certainly plug in what it would be, when I have a lot of clients that send me their rough draft tax returns. I can plug it into the calculators to show them. And then they maybe sometimes, what I see a lot of people do is go back and say, hey, are all these really business expenses? Am I being too aggressive here? And see what you can do to maximize your income. That eventually, then once filed, could help you qualify for a home loan. So that's how it works. I hope you find this educational. I can tell you this: if you're in the process with me on a home loan and you're self-employed, a lot of times there's a hesitancy like, well, I don't know if I'm going to qualify. And even though I've just showed you how it works, let me look at everything, because there's other factors, which is the home loan, the actual payment for your housing payment, your other liabilities, all that goes into your debt ratio. And I could typically, pretty much 100% of the time, come up with a plan that will get you into a house, even if it's not right now, working towards being able to buy a house. And it's so important to buy a house. Here's why. You're taking a necessary expense, which is shelter, right? So you're going to have to pay for shelter. I always tell people this: unless you're homeless or in an institution or living on the streets or still live with your mom and dad or relatives, and you're in those categories, the rest of us are either going to have to buy a house or pay rent. You have to pay for shelter, okay? So when you're paying for rent, you're paying somebody else's asset. When you buy a house, you're covering a necessary fundamental need, but you're also buying an asset that has tax advantages, and an asset that goes up in value, and an asset that also that money you pay is paying down a note that's creating net worth for yourself. So it's super important. It's really to create wealth in the United States of America and have financial independence and have a great life. It's a non-negotiable to buy a house. So you have to do that. This is how self-employment taxes work. I'm here to help. I help my clients not only get home loans, but create wealth, create the right mindsets, create budgets, create an entire plan. So reach out to me if that is attractive to you. I'm here to help. Thanks so much. Bye-bye.